a company called Quartile. So here you can see Quartile sells jewelry through stores in retail shopping centers throughout the country. So there is a company which is in the business of jewelry. So they sells the jewelry through retail shopping centers throughout the country. Now over the last 2 years, it has experienced a declining profitability and is wondering if this is related to the sector as a whole. So they observed that the company profitability is decreased from the last 2 years, and they are worried whether this decline is applicable to the whole sector, nothing but whole jewelry sector. Now it has recently subscribed to an agency that produces average ratios across many businesses. Now it means they consulted a KPO, that is knowledge process outsourcing, or an agency which provides certain industry statistics. So here below are the ratios that have been provided by the agency for quartile business sector. So they provided certain industry statistics. So based on 30th June 2002. So here we can say that the industry return on capital employed is 16.8%. Now the net assets, that is total assets less current liabilities turnover, is 1.4 million. Sorry, 1.4 times. It means the asset turnover is 1.4 times. Then gross profit margin is 35%. Then operating profit margin is 12%. And the current ratio of the industry is 1.25 to 1. It means if the current liabilities are 1, the current assets are 1.25. Then average inventory turnover ratio is 3 times. It means in a year, the industry, very important point. Try to understand this 3 times. What is this 3 times means? In a year, the industry is converting the inventory into sales 3 times. So 3 times they are converting the inventory into sales in a year. Then trade payable payment period 64 days. So the industry is taking 64 days to pay the amount to the suppliers of raw material. Debt to equity, nothing but the gearing ratio. The industry gearing ratio is 38%. Now next. Okay, now these are the industry values. So these industry values are given in the question. So they gave ROC, return on capital employed, net assets turnover ratio, gross profit margin ratio, operating profit margin, current ratio, average turnover, trade payable payment period, and debt equity ratio. Now, in addition to this, the financial statements of the quartile for the year ended is also given. So here you can find the statement of profit or loss. Now try to understand why they would have given the financial statements. So because I already mentioned, if the industry averages are given, the first step in your analysis and interpretation question is you need to compute the industry ratios. Nothing but whatever the industry ratios are given, ROC is given, capital employed is given. You should calculate the ratios of your firm. You need to calculate the ROC of your firm. You should calculate the current ratio of your firm. You should calculate the accounts payable period or the inventory turnover ratio of firm. So in order to compute those ratios, they provided these financial statements. So they gave the statement of profit or loss account, and they also gave the statement of financial position. So as I mentioned, for prepare the ratios, prepare the ratios for the quartile equivalent to those sector. So it means whatever ratios are given for the sector, for the by taking those ratios as a base, you need to compute the ratios for this quartile company. They gave the industry ratios, but you should compute for the quartile company. Then you should assess the financial performance of a company. You need to assess the performance of a company. Okay. Now I will be splitting the screen so that it will be very easy to compute because just applying the formula, just split my screen, just give me 1 second. I hope participants you can see my screen.
No, sir.
One second. Sorry. Can you see it now? Yes. Can you see my screen?
Yes, sir. Now it is visible.
Yeah. So what is the first requirement here? Prepare the ratios for quartile equivalent to those of sector. So as per the question, what ratios are given for the sector? Let me show these. These are the sector ratios. It means for quartile, you need to compute ROC, net assets turnover, gross profit, operating profit, current ratio, average inventory turnover, trade payable, debt to equity. So all these ratios are to be computed for our quartile company also. And the marks given for this is 7. So first we'll go with the return on capital employed. So here you can see the sector average return on capital employed of the sector is 16.8. So here you can take 16.8. Now you need to compute the return on capital employed for our quartile company. So as I already mentioned, return on capital employed is nothing but how much return the company got for the total capital employed. So for that, we need the revenue part. Here you can see. Yes. So in order to compute the return on capital employed, we need the profit before tax of the company. So profit before tax of the company is because generally in order to compute the return on capital employed, so we need to take the profit before tax, that is 3,400, and the finance cost. So the finance cost should be added back. So it's same thing, you can see that because return on capital employed is nothing but how much funds you invested in the company, and on that how much return you got. So in simple terms, here we need to get profit before interest and tax should be taken. But we do have only profit before tax. Once again, I repeat, the formula for return on capital employed is profit before interest and tax divided by capital employed. So here profit before tax is given 3,400, and to this if I add the tax, if I add the interest element, that is finance cost, I will be getting profit before interest and tax. So 3,400 plus 800 divided by capital employed. If you can recollect, capital employed is nothing but we should add both equity source of finance and debt source of finance. Now, in order to know the equity and debt, we need to refer the statement of financial position. So in question, they gave the statement of financial position. So here you can see the total equity source is 26,600. So we need to take equity source 26,600 plus we should also take the debt sources. That is the company loans 8,000. So 8,000. So we got the return on capital employed as 21.1, sorry, 12.1%. Participants, I hope return on capital employed is clear for all. Is it clear? ROC? Please let me know. Yes. I hope I'm audible. Is that clear about ROC, return on capital employed? Because our first ratio is ROC, which I computed. The formula for computing the return on capital employed is the profit before interest and tax divided by capital employed. Now, if you are finding difficult for this formula, so what we can do, if you can once go through the formula, I think definitely it will be easy for you to understand this. So, if you want time to go through this formula, I'm ready to give, no issue. Just you need to learn these formulas. What are these formulas? You need to learn ROC, return on capital employed, then short-term liquidity ratios, long-term solvency, and Yes, what do you think, participants? So before this explanation, if you want to learn these formulas, I'm ready to give the time. Yes, Rahul and others. Hello. Yeah, that's what I'm saying. Formulas are very simple. See, just we need to know return on capital employed means profit before interest and tax divided by capital employed. So here profit before interest and tax is not given in the question. They gave only profit before tax. So the profit before tax of the company is 3,400. Just I added the interest part, that is finance cost. Then I got profit before interest and tax. Then capital employed means we need to take both equity sources and the debt sources. So in order to know the equity and the debt, we need to refer to the statement of financial position. So the total equity sources are 26,600 and the debt sources are 8,000. So the total return on capital employed of total is 12.1. Similarly, when it comes to the net assets turnover ratio, now here in order to get this net assets turnover ratio, let me show this. Just see the total assets of the company. So net assets turnover ratio means here we need to take the sales of the company and the net assets of the company. So the sales is available from the statement of profit or loss account. Nothing but the revenue is available from the statement of profit or loss account. That is 56,000. The revenue is 56,000. Now we need the net assets of the company. So let me show you. Yeah. So generally, how we will get net assets? Any idea, participants? What, how we will be getting the net assets of the company? Anyone? Total assets minus current liabilities. So what is the total assets? Total assets are 41,800. Right. Very good, Rahul. Total assets are 41,800 because if your total equity and liabilities is 41,800 means the total assets will also be 41,800. So that's why I took it. So 41,800 minus the company current liabilities. So what are the current liabilities? 7,200. So the difference 34,600 is nothing but net assets. I hope it is clear, participants. The net assets of the company, total assets of the company minus its CL, that is nothing but current liabilities. So total assets are 41,800 minus 7,200. So that is the net. So the industry net assets turnover ratio is 1.4 times. Then the company net assets turnover ratio is 1.6 times. Now similarly, gross profit ratio, I don't think I need to give an explanation for gross profit ratio. So we need to take the gross profit and the revenue, nothing but sales. So the sector gross profit ratio is 35%, and the quartile company gross profit ratio is 25%. Then similarly, operating margin ratio. So operating margin or operating profit. So that is operating profit divided by revenue into sales, nothing but operating profit divided by sales into revenue. So the quartile company operating profit ratio is 7.5% and sector is 12%. And current ratio, so current assets divided by current liabilities. Now sector current ratio is 1.25 is to 1, but the quartile company current ratio is 1.6 is to 1. Then average inventory turnover. So this is very simple. In order to compute the average inventory turnover, nothing but inventory turnover ratio, we need cost of goods sold, nothing but cost of sales. So this cost of sales, you can get it from your statement of profit and loss. So I hope you can see this, but 42,000. This is nothing but cost of sales. So the formula for inventory turnover ratio is the cost of sales divided by average inventory. So already we have the cost of inventory, that is for nothing but cost of sales 42,000 and average inventory. So average inventory is very simple. If you add opening inventory plus closing inventory, that is 8,300 is opening inventory plus 10,200 is the closing inventory. So 8,300 plus 10,200 divided by 2, we will get the average inventory. So the average inventory is 9,200. So the inventory turnover ratio of the quartile company is 4.5 times and the sector it is 3 times. So by seeing the inventory turnover ratio, we can understand that the company performance is good. Then the trade payable payment period. Now this is very interesting thing. It means how much time the quartile company is taking to pay the payment to the supplier of raw material. Generally, industry average trade payable period is 64 days. Now the trade payable period for the company. Now, in order to compute the trade payable period, we need the purchases. We need to take purchases. So as per statement of profit and loss account, purchases is 43,900. And we should also need the payables amount. So from where we will be getting the payables, just go to the statement of financial position. Under current liabilities, you will be finding it. So trade payables as per the statement of financial position is 5,400. So the trade payable period 5,400 divided by the purchases 43,900, we got 40. So industry is taking 64 days, but your cartel company is paying the amount to the supplier only in 45 days. Now the final one, gearing ratio, debt equity ratio. So the sector gearing ratio is 38%. Now we should compute the gearing ratio of the quartile company. So in order to compute this, we need equity and debt. So equity is 26,600 and the debt is 8,000. So debt divided by equity, we got it as 30%. So these are the required ratios of the quartile. So before I go with the explanation, please let me know if you have any query on this ratio computation. Is that clear? What?
Sir, the sector average they will give, sir, or what is the thing, sir?
Sector average will be given in the question now. It will be given in the question.
Okay, sir.
Yeah. So this is a compulsory. They will give the sector. So by taking those sector ratios, first step you should calculate your firm ratios. Same ratios, whatever sector ratios are given, same ratios you should compute for your firm. So I generally I believe that it is a kind of bonus for the examinees because just you need to substitute the formula and you will be getting around 6 to 7 marks, right? So it is a kind of bonus to you. So any other queries on these ratios, participants? Shall I go with the explanation? Clear?
Clear, sir.
Yes. Now just see the second requirement in the question. So first requirement we are done. 7 marks is done. Prepare the ratios for the quartile. Now the second requirement is assess the financial and operating performance of quartile in compared to sector. So we need to compare the sector ratios with quartile ratios, and we need to assess the financial performance. Participants, if you can recollect, when you are giving your comment on the performance of a company, always you need to include three compulsory heads: profitability, liquidity, solvency or gearing, and you should also give conclusion. These are the common heads. Your examiner will first see whether these heads are there. So you need to keep these as side headings: profitability, liquidity, and the next one gearing ratio or solvency, and the last one is conclusion. So here you can see about the profitability. So in the profitability, as I mentioned, what is the primary profitability ratio? Return on capital employed. I already explained this. So when you are giving your opinion on the profitability of the company, start with the ROC, that is return on capital employed. So here the ROC of a company industry is 16.8%. Now very, very important, try to understand, please focus on this. The return on capital employed of the company is 16.8%, but sorry, of sector is 16.8%, but your company is only 12.1. Now try to understand the presentation here. The primary measure of profitability is the return on capital employed, and this shows that the quartile 12.1% is considerably underperforming the sector average of 16.8%. So sector is 16, but your firm is only 12.1. So the main cause of this scene. Now this is very, 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 very interesting. Most of the students try to skip this point. What they will be doing is they will write only this point. The company return on capital employed is less than the industry. But your examiner is not expecting this. In order to state that particular statement, it is not necessary that you should do ACC, right? See, a normal lay person can also say the difference. So what examiner will be considering is the main cause. The main cause of this seems to be a much lower gross margin, 25% compared to the 35%. Why the return on capital employed of the company is less? Because the gross profit of the industry is 35, but your company is only 25. Because of lower gross profit, your return on capital employed is less. Why the gross profit is less? Now this statement is also not sufficient. Why the gross profit is less? See this one. A possible explanation for this is that Quartile is deliberately charging a lower markup in order to increase its sales by undercutting the market. It means it might be a reason. Always don't try to make a statement there. Just try to express your opinion. It might be. So the possible explanation for this is that the quartile is deliberately charging a lower gross profit, nothing but lower markup in order to increase its sales by undercutting the market. So it means the company may want to maximize its sales. So how I can know that the company is planning to maximize its sale? Now just see this one. Inventory turnover. Industry inventory turnover is 3 times. It means every year industry is converting the inventory into sales only 3 times, but your firm is converting the inventory into sales 4.5 times. It means your firm sales are very high compared to the industry. How they achieved that? Maybe by decreasing their profit markup. I hope it makes sense, right, participants? Yes. Yes, can I get your opinion on this? The company might have increased their sales by decreasing their profit margin. So here you can see the possible explanation for this that the quartile is deliberately charging a lower markup in order to increase its sales by undercutting the market. And there is supporting evidence for that. So just giving a statement is not sufficient. So why I say that the company is undercutting the profit? By considering the average inventory turnover ratio. So the proof, as I mentioned, it. So there is a supporting evidence. Now, alternatively, one more statement. An alternative statement explanation could be that the cartel has had to cut its margin due to poor sales, which have had knock-on effect of having to write down closing inventory. So, an alternative explanation could be that cartel has to cut its margin due to poor sales, which have had a knock-on effect of having a write down closing inventory. So the company, in order to what is this come out of the poor sale, the company might have forcefully decreased their profit because no company will intentionally minimize their profit margin. Previously, they might have faced some issues with the poor sales, so that's why they decrease in their profit. Right now, the quartile lower gross profit percentage has fed through to contribute to a lower operating margin at 7.5% compared to the sector. So here the operating margin is also is 7.5%, but the sector is 12%. However, from the above figures, it can be deduced that the company operating cost at 17.5%. Now, how we got the operating cost? This is very simple. Gross profit ratio minus operating profit ratio is nothing but operating cost percent. So here you can understand the sector operating cost is 23%. The sector operating cost is 23%, but your company operating cost that is 17.5%. So it means the revenue appear to be better controlled than the sector average operating cost. So this may indicate that the quartile has a different classification of cost between the cost of sales and operating cost than the entities in the. It means the reason. So here again the reason why the sector operating cost percentage is 23 and why your company uh, operating cost is 17.5. The reason might be the treatment of cost. So here you can see the sector average or the entity may be spending. It means the sector might be spending more amount on the selling and distribution because already we quoted one point that the companies intentionally reduces their profit margin. So now what does it mean if the company is intentionally reducing because the sector gross profit ratio is 35%. Now, if you want to get a gross profit ratio of 35%, so definitely the companies need to spend huge amount on selling and distribution. But in this case, the company gross profit ratio is less. So that's why the quartile company might be spending less amount on advertisement and selling. So that is also one of the reason for a less operating cost compared to the sector. So is the clear participants up to this? Any query? Is that clear? Yes. So I think can I go to the next element? So here the other components of return on capital employed is asset utilization, that is net assets turnover ratio. So if the company business strategy is indeed to generate more sales to compensate for the lower profit margin, very interesting. Please try to understand. So here we were in opinion that the company want to increase more sales. It means in order to compensate the lower margin on profit, so the company want to compensate it by increasing the sales. So higher net assets turnover would be expected. It means that if the company want to increase the sales, the net assets turnover ratio should be very high. So a higher net assets turnover would be expected. So at 1.6 times, now try to understand this. The industry net assets turnover ratio. Let me once again show this. Here, the net assets turnover ratio. Industry net assets turnover ratio is 1.4 times, and your company net assets turnover ratio is 1.6 times. See, if there is a deviation, if there is a deviation of 10% in your gross profit, then there should be a significant change in the net assets turnover ratio, because industry is only 1.4 and your company is only 1.6. There is no much difference in that. So the same point is explained here. At 1.6 times, the quarter net assets turnover ratio is only marginally better than the sector average. So this indicates that the quartile strategy was a poor choice. So what is the quartile strategy? Increasing, nothing but compensating the lower percentage of profit by increasing the sales. It is a poor choice. So then the ratio could be partly distorted by the property. And one more interesting thing is the net assets turnover ratio. First, we need to see. Generally, we will compute the profits for this. Now, let me show this one. Let me show the statement of profit and loss. Because when you are computing the net assets turnover ratio, we'll take total assets minus current liabilities. But an important thing you need to consider, in your total assets, there is one deferred development expenditure. Now, if you try to exclude that and to try to compute the 5,000 is a development expenditure, and one more element is also there, that is related to the revaluation. Now, let me open my statement of profit and loss account. You can understand this revaluation effect also. Oh, yeah. One second. Yeah. So this revaluation is there in your statement of financial position. Let me show this. Here you can see there is a property revaluation surplus of 3,000. So your net assets turnover ratio might be affected because of these. Because the net assets 34,600 we got by considering these two also. So if you try to eliminate these two, then you got a net assets turnover ratio of 2.1. So which is 50% better than the sector average. So in summary, the quartile overall profitability is below that of its rival businesses due to the main reason for the less profitability is by cutting the profit margin, because the strategy of the company is to maximize their sales by cutting their profits. So because of that, the company profitability has been affected compared with the industry. So that is about the profitability. Then when it comes to the liquidity part, so I already mentioned in case of liquidity, we need to highlight the current ratios. So as a measured by the current ratio, the quartile has a higher level of cover for its current liabilities than the sector average, because the sector average is only 1.25, but the quartile company, the current ratio is 1.6. It means they are in a better position to cover their current liabilities. But the quartile figure is near to the norm of expected liquidity ratio, because I already mentioned for a new company, 2:1 is an ideal current ratio. For an existing company, 1.7 can be considered as an ideal current ratio. So here in this case, it is 1.6. So it is very near to the ideal liquidity ratio. Now here, the problem of this with the sector average, the problem of this is that the generally accepted that relates to the manufacturing rather than the retail. So as applies to the quartile and presumably also the sector average. So retail entities have very little. Now very interesting point you need to understand. In case of retail entities, the trade receivables. Retail entities have very little, if any, trade receivables, as this case with the quartile. So this makes a big difference to the current ratio and makes the calculation of a quick ratio largely irrelevant. So retail entities operate comfortably with much lower current ratio as their inventory they turn directly to the cash. Because I hope for participants you can understand, If a company is in the retail sector, means the percentage of receivables will be very less, because directly most of the transactions will be on cash basis only. So the receivables will have less effect on this. So the quartile has a higher current ratio that might be expected. So as quartile has relatively low inventory levels, so deduced from the high inventory turnover figures, this means that it must also have relatively low level of trade payables. Now here the trade payables also you can understand. The industry trade payables was around 65 days, but the company trade payables is only 45 days. So in simple terms, by understanding this liquidity aspect, we can easily conclude that the company don't have much liquidity issues. So the liquidity position of the company is good. Now the same thing for gearing ratio. So this is very simple, already given. The sector gearing ratio is 38%, but our company gearing ratio is 30%. You can see that. So the low non-interest rate of 10% might appear quite high. It is lower than the return on capital employed, which means that the shareholders are benefiting from borrowing. So quartile also has sufficient tangible assets to give more than adequate security for the borrowing. So it means that one more point I want to add: if a company gearing ratio is more than 40%, it is considered that it might create certain adverse consequences to it. But in this case, the industry gearing ratio is 38 and your company is only 30%. It means they don't have much gearing issues. So they do have very good gearing position, and even they do have very good liquidity position, but only the profitability is not up to the mark of sector. That is because the reason might be the company want to maximize their sales by cutting their profits. Now, so conclusion. So quartile may be right to be concerned about declining the profit. So from the above analysis, it seems that the quartile may be addressing the wrong market, low margin with high volumes. So the information provided about these rival businesses would appear to suggest that the current market appears to favor a strategy of higher margin. It means the company might consider the highest margin. So how the higher margin can be achieved? By providing a better quality, or because the company is in jewelry sector, so they might design certain expensive goods, so with that they can get higher profit. So this is the analysis and profitability, liquidity, gearing and conclusion.